So the first thing I wanted to cover is why valuation is so hard pre-seed, pre-revenue. And by the way, this diagram doesn't represent pre-seed, pre-revenue. This is to show you what easy can look like. So when I exited my business, it was a really, really straightforward conversation. You take your company's EBIT, your retained profit, if you like, and you take a multiple and you multiply the two together and you come up with a number. And that is how much your business is worth. It is no more complex than that. Two numbers, multiply, that is it. Now, you can debate, both of those numbers can have a bit of wiggle room. So, with EBIT, for example, you can have add backs and take away. So, if you've had some exceptional costs in the last year of, say, 200 grand to, I don't know, renovate a property or whatever, and that's not normal cost, then you would add that back into your EBIT and say, run rate costs wouldn't include it. And that, on the opposite side, if your books require it, you can take some of the EBIT away. But broadly, that figure is very readily agreed. And then you come to the multiple. And the multiple just means what are we going to times the other number by in order to come up with a value? And in most circumstances, in my tech company, the average industry multiple was about 8.5 times. So naively, you'd have taken our whatever it was, three and a bit million pounds EBIT at the time, multiplied it by 8.5, and come up with some number I can't do off the top of my head. We actually argued the multiple in our case should be a bit higher because we had good quality of earnings, we had lots of recurring revenue. There were lots of things that you can see around this diagram that we tick the box on. So that was good. We actually ended up as a multiple of 10. So we took 3 point something times 10, and that was what the business is worth when we exited. Really straightforward. You can debate both the numbers, but there is a well-trodden path to doing so. If you're an exceptional business, so if you're a SaaS business, for example, sometimes you're not multiplying your EBIT by a multiple, you're multiplying your revenue by a multiple. Now, the revenue probably won't be 10 times as our exit. It will be 3 or 4 times your revenue or whatever it happens to be in your sector. But that is usually much more attractive. So if you possibly can, if you're in a sector, you'll push for a multiple times revenue. We couldn't in our business, so we went through EBIT times a multiple. So you're probably scratching your head saying, well, that all sounds very straightforward. Where's the problem? Now, the problem is most of this conversation today is around pre-seed, pre-revenue. You've got nothing to multiply by. So if your EBIT and revenue is zero or minus, even in the case of EBIT, you can't do an EBIT times multiple because it just makes no sense. Your company would have no value, or you would be paying investors to take shares off your hands, which is a bad idea for the avoidance of doubt. So you cannot use a very straightforward, naive methodology. And what I wanted to introduce on the next page are a few of the methodologies that are used in the UK. And lots of these, pretty much almost all of these, rely on you having some previous reliable, predictable revenue and or EBIT so that you can then perform some agreed calculation that your investors. So things like the first Chicago method or the VC method or the revenue or earnings multiple or discounted cash flow, all of those mean that you need to base your calculations on some existing figures. If you're already pre-seed, pre-revenue, that's just not possible because you don't have any revenue probably, and almost certainly no decent EBIT you want to multiply by anything. So for lots of reasons, those methodologies just don't work for an early stage. So what do you do when you are pre-seed, pre-revenue? The answer is, and there are the three methodologies at the bottom right here are the ones considered for pre-seed, pre-revenue. There is a Berkus, there is a scorecard, and for me, both of those are pretty much related. They feel very similar. Or you get simple comparables. Let's start with a simple comparable. Imagine, imagine you've got a business that makes, I don't know, fragrances. You found a business at a similar stage in a similar sector that makes fragrances. And you can see that they did a funding round and their valuation for the purpose of a funding round at an equivalent stage to you was 2 million quid. You would say to your investors, our valuation is 2 million quid because their valuation was 2 million pounds. And what you might be able to do is argue for a slightly higher valuation. You may say, well, their team, hasn't got proven exits. They don't have a PhD in a relevant subject, and. So you can argue why your valuation may be a bit higher, but broadly, you're taking somebody else who some other business which seems very similar to yours and using it as an anchor where you can move up or down from. So simple comparables is probably the easiest to fall back on. Burkers and scorecard are both, I use them in the same breath, really. Broadly, that is where you take an industry average and hopefully a sector average for your sector, and you say, well, for this type of business, or for an average pre-seed pre-revenue, the valuation's 1.5 million, and we think we are better because we've got an ex-founder, we've got somebody with PhD, we've got patents, we've got da, 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 and you argue that your score is more from that industry average. And both Burkers and Scorecard have standard buckets in which you can argue that your valuation should be more than 1.5 million. And both of those are related. In a few slides time, I can give you an insight into how I look at valuing pre-seed, pre-revenue businesses based upon my own kind of my own interpretation of Burkers, really. So what does normal look like? I mentioned before in the last slide, what does normal look like pre-seed, pre-revenue? I should caveat this slide with, if you are in AI or deep tech, then these numbers are all going to be wrong. If you're in AI, everybody knows that the market's currently booming in AI. And a few years ago, it was in blockchain. And a few years before that, it was, fintech. The types of businesses that are in vogue at any one time comes and goes. But for an AI business, these numbers can be put in the bin. But for any non-AI business at the moment and any non-deep tech, then the average pre-money valuation, pre-seed, pre-revenue is around 1.5 million. Now, if your business is amazingly attractive to investors, you've already built a product, you've already got 50,000 MRR, you've got patents, you've got partnership with some big household names, then your valuation, maybe double that. It might be 3 million. However, if your business is unattractive compared with the average, so if you're currently making jam in your shed, you've only sold a few jars to your nan, and you're not really at the point of scaling up, then your valuation may be 800,000 to 1 million. So you've really got to work out where you sit in terms of that attractiveness to investors, and I'll cover that in a few slides. But there or thereabouts, you'll probably end up being somewhere about 1.5 million. The average raise at that point is £250,000. And that, funny enough, is the SEIS limit in the UK. So most pre-seed, pre-revenue funding rounds will raise up to the SEIS limit of £250,000. And then they'll use the next funding round, the seed funding round, potentially to lean into EIS. Now, some first funding rounds, you absolutely can have a £300,000 raise or a £500,000 raise, even pre-seed, pre-revenue. You've got to make sure, though, you've got to sanity check that your percentage dilution is correct. And that's the kind of third part of the triangle. I think it's really useful when you're considering your kind of valuation and your raise amount to consider all three variables here, and they're all related. So the first variable is how much you're raising. The second variable in the triangle is what your valuation, and the third is the percentage dilution that your business will receive as a result of taking on the investment. And you want to make sure that each of those three is same. So you don't want your pre-money valuation to be too high, too low. You don't want to be raising too much or too little. And your investors are going to expect your percentage dilution to be somewhere between 15 and 20%. If you're only diluting by 10% in a funding round, it usually means one of two things. It usually means your valuation's too high or you're raising too little. One of those two things will be indicated. And that's a red flag to an investor. Also, a red flag is, diluting by, say, 30% in a funding round. Very bad things happen if you dilute too much, both for you as a founder, but also for your early stage investors. So your investors are going to sanity check all three of these numbers to make sure they are within norms that they're comfortable with. People always ask me, where did the figures come from on this chart? There is a really great company called Bowhurst. You should go out and check their website. Bowhurst track every single funding round in the UK, and they produce quarterly reports. We've got to be due one any day now, actually. But anyway, they produce quarterly reports which show, and yearly reports which show the state of the UK funding round scene. They break funding rounds by sector, by geography, by stage. And every year or so they publish what the average pre-money valuation is. And even in the latest figures, the average pre-seed pre-revenue is about 1.5 million, unless you're in AI and deep tech, in which case the game changes. Now you may be thinking, right, I need to raise £2 million over the next 5 years to achieve my dreams, to get to where we need to be. Then we'll be profitable. So I'm going to raise £2 million in my first funding round. Do not do that. That is a very bad idea. And the reason for that, you can hopefully see, if the average valuation is 1.5 million and your valuation is 1.5 million, and you are raising £2 million, you are going to give a huge amount of your company away when you close the funding round. So two problems there. Firstly, no investor is going to take you serious because they know it's bonkers. And the second thing is, yeah, you will leave yourself with a much smaller percentage of the business than you would need to. So what do? If you know you need £2,000, £2 million, sorry, over the next 5 years, you do something called tranching your funding journey into different stages and different funding raises. And you can see this here. In this journey, we're bootstrapping. The founders are bootstrapping for a bit. Maybe they're taking 50,000 from friends and family to keep the lights on. They then do this pre-seed, which will probably be 1.5 million valuation, raising 250K. They do something. Oops, sorry. They do something with that money that they've raised, the 250K, so they get more traction, and then they raise their seed round at a much higher valuation, which means after this, when they get through to Series A or B or wherever their journey ends, they'll have raised the same £2 million, but they will end up owning, because the valuation's always increasing over time, they will end up owning a much bigger part of the business than they would if they tried raising the 2 million up front. We have something, I mentioned our free stuff on the Founder Catalyst website. We've got a page which includes a whole bunch of free stuff, and I'll put a link to this in the chat. One of the things we do include is a cap table modeling tool, which allows you to model your journey from, incorporation through bootstrap, through family and friends, all the way through to an exit. And maybe Ivan and I can have a deep dive if it's appropriate at the end. But there's a few really important things here to explain how the model works. The first is, at the top, you put your valuation at each of those tranches of funding. And, you can see here, we've got friends and family at 800 in this instance, 1.4 at pre-seed, and so on. So it's always increasing significantly. The amount that your investors are investing during that funding round increases. You can see the amount that people are putting in. We then do internal rate of return, or IRR returns, so you can work out that it is sane, the kind of return that investors are getting on their money. Early stage angels won't worry about IRR. Most angels don't think in that way, but later stage VCs and funds absolutely will. You can see we calculate your post-money valuation on the next line. That's a very straightforward calculation. It's the pre-money plus the investment, and then how much equity has been allocated in the round. And then we tell you on the next section how much in the funding round that the founders retain. So you can see when you're bootstrapping, you own all of the company. When you get to closing your Series C, you own 34% in this model, and therefore this is the amount investors own. And you can see somewhere here we add an employee option scheme as well. You can see here we add an employee option scheme, and this is the amount the employee option scheme owns at the end. And then all the way to the bottom here, we explain how much each of these groups are getting. So what is Series C getting within an exit? They're getting 7.7 million quid on their £6 million investment, and the founders are getting 13 million quid based upon their investment. The really important things at the bottom are the internal rate of return, which will matter very much to VCs, but also the total return on investment. And this is much more aligned with how angels think. Angels are much more worried about, if I put £100,000 in, how much am I getting back? If I get over £1 million, well, that's brilliant. If I get, if I'm only getting 150 grand back, that is, that does not offset my risk, even with SEI, EIS bundled in. So the spreadsheet's available from our free stuff, and it's a really lovely way of you saying, well, I think we're going to need 3 funding rounds. I think we're going to raise 250, 500,000 and 1 million, say, and you can sanity check that the IRR and the return on investment type multiple all stack up. I promised a few slides ago that I would talk through how I analyze startups, what my methodology is. So frankly, I kind of once thought it would be useful for me to document how I assess businesses, and this is my mind map. And broadly, there are 8 categories here. You can see, the most important for me is team. I go there first. If the team's great, and then I'll kind of move on to the other items around. But if the team's no good, if the team doesn't score very high, I just won't end up investing in the business anyway. But for me, mentally, what I do, and I've actually got a spreadsheet which works this out. I've got a spreadsheet which has each of the criteria here, so team, deal, competition, market, and so on. I've got a score out of 10, and then I've got a weighting for each of those. So, I may give a weighting of 3 times for team, whereas, exit strategy, I'll only have 1 times. Ultimately, what that all adds up, I score each of the criteria, and that spits out a number. And that then tells me, firstly, if it's more than 7 out of 10, am I interested in investing at? But it can also tell me, if the average valuation is 1.5 million, if the score's 10 out of 10, then, I'll probably double that to 3 million. If it's 5 out of 10, it might be, 800,000 or whatever, if I really love the founders and want to support them. But lots of investors will use this kind of thought process and that exactly the same kind of scoring matrix to go from taking your pitch to thinking about your pitch to coming up with a real score that allows me to vary that valuation. Um, Before I hand over to Ivan, I wanted to talk through a really classic example of what not to do. And in this instance, the founder used an accountant who used a tool called Equidam. Now, Equidam is a tool you can use on the internet. It allows you to plug in lots of figures around, your business's metrics and the future growth and all of those kind of things. And it will use lots of the scientific methods that we spoke about earlier. It will calculate what your business is valued at using the methods. And for the avoidance of doubt, I think Equidam's a great tool. But as with every tool, there is a theme of garbage in, garbage out. In as much as if you put rubbish figures in and overly optimistic figures, and if you use the tool in the wrong way, it is going to give you very misleading results that investors will run away from. And that's exactly what happened here. And it's double embarrassing for the founder, really, because they relied on an accountant to come up with a valuation, and the accountant blindly poured numbers into Equidam, and the numbers were ridiculous. And let me give you the example. So the founder was pre-seed, pre-revenue. So, they should be, and it was a physical product, hadn't started manufacturing. So, the valuation should have been about 1.4, 1.5, I would imagine. In this instance, the founder or the accountant on behalf of the founder, they did 3 methodologies. They did a Berkus methodology, and that gave a valuation of about 1.5 million. They gave a discounted cash flow valuation based upon their 7-year projections. And because they said they were going to be a unicorn, they were like, well, in year 7, we're going to have £1 billion revenue. So they used a discounted cash flow on that. And then they used the VC method that Ivan's going to talk through in a moment. And the DCF came up with a valuation of, I don't know, it was something like 450 million. And the VC method came up with something similar. So they had one valuation at 1.5 million and 2 which are closer to than $500 million. Now, the accountant should have said, this is ridiculous. You don't have such crazy divergence between valuations, but they didn't do that. They applied no sanity to it. What the accountant did was a weighted average across the 3 scores, and they said, we're going to weight the Berkus method at 20%, and we're going to weight the other 2 at 40% each. Actually, I think it was the opposite way around. I think it was 60-20-20. The outcome's the same. But because the 2 $500 million valuations were so massive, 20% of a massive number is still pretty big. So it came out with something like a 200 million valuation for a business which should have had a valuation of 1.5 million. Despite me having a conversation with the founder, thankfully they weren't an FC customer. Despite me having a conversation, they were wedded to the 200 million valuation. And yeah, I wasn't surprised they gave up fundraising and closed their business shortly after. So that is a really good example of what not to do. Yeah, just a bit crazy.
I
Ivan?
think that's the biggest issue, isn't it? I mean, you use the tool, garbage in, garbage out, you give a wrong answer. At that point, the founder is fixated to that sort of valuation. Oh, my business is worth this much. Anyone
Yeah.
who say otherwise doesn't actually appreciate the value in my business. This number has been verified, validated by my accountant, by this platform. So that it becomes very hard for the founder to turn around to something sensible. In your case, you weren't able to bring him down to earth. I've come across similar cases as well. It's bloody difficult at that point to bring them back to the normal path.
There's an emotional attachment. And the problem is when they see that, the next thing they see, once they do the valuation, they'll go, right, so I need to raise, I'm going to dilute by 15 to 20%. So I'm going to raise whatever it is, 100 million quid, and this is how I'm going to spend it. So they kind of do that. All of their material is built around 100 million pound raise, which is ridiculous. Oh, one final amusing thing, Ivan, before I hand over to you, and I promise I will. In this instance, the founder was only raising £200,000. So they were diluting. I can't even do the mental maths, but the dilution was something like 0.01%, and you kind of look at it and go, "Oh, this is it's crazy." And I did feel for the founder, but like I say, they were emotionally attached. So, Ivan, that is I'm sure you've got a few war stories you can tell at the end of your session, but I think firstly you're going to tell us about the art of negotiation when it comes to valuation.
Yeah. Well, thanks for the explanation about fundraising. That was enlightening. I love the spreadsheet that you shared earlier. I do encourage the audience here to go to download it. That's something you haven't quite pointed out, but there was a number there that I really look at. Like at Series A seed, I think you had 60%, 70% ownership still retained by the founders, right? And that's a very good number to look at. It ties in back to what you were saying earlier about what's the right dilution at the pre-seed, at seed stage. Because one of the elements investors would look at is when it comes to seed stage or Series A, the VC wants to know how much shares does the founder still retain. If the founders have 50% or 40%, whereas all the other companies, the founders still have 70% in a normalized situation, there's a concern here. Is the founder still incentivized, motivated? Has the investors taken too much shares? So I think that's one of a very good output coming from a spreadsheet exercise that from your template. So to the negotiation. The advice I give to founders is always this: the best negotiation happens when you don't actually need to. If you are able to walk away and say no to an offer, you've actually got the power. Maybe you still have cash in the bank. You are not desperate for funding, so you don't need to take that offer. If you have a lead investor and you can tell this investor that somebody else is putting money in at this valuation, this investor knows that he's not going to be the first fool you pitch to. Somebody else has really done their work. They're investing, or maybe you have enough interest to syndicate the round. So you want to raise 250K. You've got 10 investors, each of them put in 10K. That's £100,000. And you tell that to any investors, it's harder for them to come back to you and say, "Oh, okay, there's 10 investors invested at that valuation, but I want to invest at this valuation instead," right? So it's harder for them to negotiate. You've got the card in your hand. But the best is if you can turn around the table to say no and choose, be very selective with who you take the money from. That's the best way to structure the round. So one of my company, a client, Artifact AI, they want to raise £3 million. They went to pitch. They got A16Z involved, putting 1.5 million in, and went to the pitch demo. They got lots of interest from Microsoft, from OpenAI executives. In the end, they received an interest up to 10 mil. So they were in trouble. The trouble is, who do they say no to? And we went up going to all the express interest lists and say, okay, we want this investor, we want to limit how much he invests so we can get the other person in, right? So that's the best way you can negotiate around. If you can say no, do you have a lead investor or you go oversubscribe? So next slide, if you can, Sam. A common mistake made by first-time fundraiser, which Sam has said in his horror story, is this: my valuation is X because DCF, VCM, my accountant say so. I've got lots of requests from founders as well coming to me and say, Ivan, can you help me to build a valuation tool? Because I need to justify the numbers to investors. And I say, hold on, take a step back. Why do we go into this sort of conversation in the first place? Let's unwrap this, right? Because in practice, you don't often negotiate with that kind of technicality, right? It can be something as basic as, I offer 4 million, you want 5 million, why don't we meet in the middle? This is an actual deal that happened. I was on the holiday and the founder called me and said, I've got this offer from the investor, it's lower than what I want. What do I do? And I say, go back to propose. Are you happy to accept that? If you cut in the middle, he said yes. I said, go back to say this is how much you want. And he got the deal. That's it. As it doesn't have to be that technical. Next slide, please. Thank you. So valuation is not a single decision made at the end of the process, right? It starts from the beginning, the moment you start pitching, the moment you start presenting the business to investors. And as they get to know you, get to know the team, get to know the idea, they form some level of value judgment and say, okay, this is how much you need, this is how much I'm willing to pay for, right? And your job is not to wait until the end to convince him that valuation about a specific number, right? It's about presenting a whole compelling narrative right from the get-go that this is a great business they should invest in. Next slide, please. And at the end of that process, if they do their due diligence, so they got their lawyer involved, their wealth manager or analyst, and they look at your pitch material, what you've told me, right? And they check the facts, check the documents, and there's no surprises, everything checks out. Then you would have really come to a point that you've got an indication where the value is. So you're not going to be stuck at that point and say, right, this is my valuation, this is my VCM calculator or DCF, right? Because you already converged towards that journey right from the start. But if the due diligence throw out some surprises, if you claim you've got X amount of recurring revenue, as it turns out, you buried within that recurring revenue a one-off consultancy project. That is not a representation of your recurring revenue. That is a letdown of trust. And that surprises is what would deviate the valuation discussion. Next slide, please. So comes to the VCM method. This is one of the most popular method used by late-stage venture capital firms. Hence, it's called venture capital method. For pre-seed stage, you don't have that much data to go around, so it's actually tougher to use as a tool. But I would still use this as a way to sense check the numbers. So you have your financial model, you present the numbers, and you want to pitch to investors like a VC or angels, and they have certain expectations. Does your pitch material, your forecast number, match with what you are presenting and who you're pitching to? So VCM is still useful in that sense as a sense check tool, right? Now, the principle is very easy. You calculate the terminal value in X number of years, maybe it's 5 years from now or 7 years from now. How much will the company exit for? If I want to make 10 times my money, what is the valuation today? So take an example here. If a SaaS company can be sold for 100 million pounds in year 5, I want to make 10 times my money. I need to invest in the business at 10 million post money. But the reality is not as simple, which I'll show you in the next slide. Now, the spreadsheet time. When you want to build a venture capital motor, we've got the IRR, all the numbers. You look at the terminal, enterprise value, you need to add the cash minus the debt, so on and so forth. But if we take away that complexities, next slide, please. Straight away, the complexity, this is what it boils down to. What is your terminal value? How do we calculate that? How much investment is making this by this investor or this funding round? What's the terminal year? So in this instance, say you've got a 5 years forecast that you present to the investor. I'll take your final year. I'll then figure out what's the exit multiple. So as Sam explained, it can be revenue or EBITDA multiple. In my example, I use revenue multiple. Now, to calculate what's the right multiple, there's multiple ways to do it. You can go to the public market, so stock exchange, S&P 500 or FTSE, look for some companies within your sector. That's the easiest because all the data is out there. M&A transaction, so some company get acquired in year 5, 7, 8 in their journey. And if you can find out what's the multiple, that's quite relevant. That will, to me, is more relevant to a VCM method, because most companies exit through M&A. But it's harder to find the detail because not all the M&A transaction is available online. Then comes the VC investment. In some way, this is comparable. So if a investor VC makes in Series C X million pounds at different valuation, and you say in year 5, this is the journey I'm going to go to. So what is the multiple years at the time? That is actually the hardest info to try to get because it's private. VCs don't disclose this, founders keep it to their chest. So that's actually the hardest information to research. Next slide.
Just to interrupt, sorry to interrupt your flow, but there's a few interesting points on this. So sometimes it is, if you know somebody's closed the funding round, then by looking at SHO1 and confirmation statements, you can work out pretty closely how much was invested, how many shares they got, and therefore the valuation. So it's sometimes possible to backport. There's also, I think BDO, the accounting firm BDO, do a generic kind of multiple by quarter that you can download from their website. And there are, if you're in hospitality, for example, there are specific publications which show multiple by sector, which I think they kind of fall into the second group here, and the VC lookup on Companies House is the third group. So it's sometimes worth doing a bit digging. As you say, the more specific you can be, and the closest proxy you can have to your company, the better, really, for justifying.
Yeah, absolutely. So in here, an example, if the company terminal value is at 100 mil, we want 10 times return. If I invest 250K, the pre-seed average at 10 million post money, you can see in this table on the first column, that's the return multiple I require. So I need to invest in valuation of 10 mil and own 2.5% in the company. And when the company exits 400 mil, I get 2.5 million. So you check it. From 250K, I get 2.5 million back. When the company exit, I got 10 times return, all checked. So on the first column, it checks with the final column. And you go down the 5 times, 10 times, 20 times to 100 times, right? So theoretically, if I want 10 times my return, I just need to invest at 10 mil. But the reality doesn't say that, right? Because if you look at the data shared by Sam earlier, the average valuation is 1.5 million pre, right? So that's more nuance to this. Next slide, please. So that nuance is called dilution, or one of the major nuances. If the company raised pre-seed, then goes through another few more rounds, typical journey will be seed, Series A, Series B, Series C, Series D, and say it's 15% valuation to investors and founders in each round. You can see that in the fourth column here, initial equity of 2.5 if I invested at 10 mil post. At terminal, I will be left with just 1.1%. So for 100 million exit, I only get 1.1 million pounds, which is just 4.4 times my initial investment. So that's very different from the return multiple I asked for at the beginning because of this dilution. From 10 times, it dropped to 4.4 times. And in fact, if I want to get to about 10 times, you should be aiming at about 20 times return right at the beginning or 25 times, so that on the last column, you get to about 10 times. There are other details as well, right? Details like preemption, getting EIS, SEIS tax relief, pref shares, warranties, which go beyond the scope, but is nevertheless of this discussion, but is nevertheless very important because that change the return for the investor and affects the shareholding of the founders. Next slide. So to wrap this up, we talk about VCM, we look at the terminal value, how to calculate that. We look at the return multiples and the impact of the dilution. The elephant in the room here is, what does investor actually want? Do you want 10 times? Do you want 25 times or 100 times? So a naive investor like myself, if I say, I want 10 times, so I invest at 10 mil. We have shown that just through the dilution itself, I'm not getting my 10 times. So a smart investor like Sam, he will say, I want 10 times, but I know I'm going to get some dilution. So I need to actually aim for 25 times so that at the end, I have a chance to 10 times my money on this deal, right? But for a seasoned investor with portfolio approach or sharp like VCs, if they'll be thinking along this line, right? I want 10 times across my portfolio of 50 companies, but 90% of those companies are going to fail. So I actually rely on the 10% of my companies to succeed to give me the return I need across my portfolio. So as a result, they might actually need 100 times return on paper for that particular deal. So in this case, you can say the valuation is close to 1 mil, right? Or if it's 60 times, it's 1.7 mil. So that kind of explains why you see the average industry benchmark pre-money is 1.5, because they need to aim high 60 times, 100 times in anticipation of dilution, in anticipation of the other companies within their portfolio failing. And if you then succeed, you're going to make back all the money they need in order for the entire portfolio to have the kind of return that is respectable. VC is still a business. I always say that VC is a business at the end of the day. I think that marks the end of my presentation.
It does. And what a great point to finish on around, lots of founders don't understand the dynamics of VCs. They don't understand, and everybody should Google this straight after if you're even thinking of, seeking investment from VCs. There's something called the power law, whereby, in order to return the fund, they're expecting all but one or two of their fund companies to either fizzle and fail completely or, deliver 1 times, 2 times return, which frankly is a failure to them. They are relying on 1 or 2 of the businesses to end up as unicorns and to, give 100 times return, and they actually return all of the benefit from the fund. So it's not that VCs have a great batting average, it's that VCs invest in lots of companies and they're relying on one of those companies to do ridiculously well. So yeah, really appreciate your perspective on that, Ivor. And it's interesting seeing, my naive, I think I'm a fairly sophisticated angel, but I'm all about, the scorecard. What does average look like? Where's my heart and mind at about investing in this team and their idea and the game changes entirely when you get into maybe some of the SEIS funds, but I think it's mainly the VCs where the game changes, and it's about spreadsheets and VC method, discounted cash flow, and they're looking at the business from a totally different set of angles, as well as sanity checking that the business can in principle be a unicorn. I think that's a really, really strong distinction between how both ends of the kind of ecosystem work.
Yeah, I think those are keys, right? At pre-ref, what we know that you can use some tools to justify the numbers, sense check, but that's not how the angels think. And you want to play their game, right? You want to speak to their mind, speak their language. So you don't want to go technical and say DCF, VCM, this is what my accountant says. It's about the people, about the team, about the business idea. And if you've got any investors who say otherwise, probably they are at the wrong stage, or you approach them. That's not the right investor for you. I think that's one key point to take away as well. Some investors are naive; they got lots of money, but doesn't mean that they are good at investing. And getting the wrong investor can have repercussion down the line. I'll share a horror story, right? One of my company got investment, great investor, lots of money, lots of good background, career behind him. And that investor gets about 35% of the business.
Wow.
So when it gets to seed stage, pitching to a VC, and the VC look at that cap table and say, well, gosh, you're so diluted amongst 2-3 co-founders, and one of the co-founders also left the business without any claim back of the shares. So the real founders who are still doing the hard work, the slouch, only has like 50%, 40% left. That's that. There's no way any investor will fund that anymore. It's a dead venture.
Yeah. So there's a couple of, if anybody's got any questions, we've reached the end of the session. There's a couple of points that I think I wanted to add on at the end, and then we can dive into any Q&A. So some people have asked, can we have a link to the cap table modeling tool I spoke about? I've just put a link in the chat there. I'll put Ivan and my contact details if anybody wants to book a call with either Ivan or I, or it'd be great to connect with you all on LinkedIn if we're not already anyway. So all of those are going there. I guess to finish off on the content, if nobody's got any questions, that's absolutely fine. We'll finish up early, and I'm feeling a bit peckish actually. But I think so many founders get hung up on valuation rather than the value their investors would bring. And I guess to give a made up example, if you could have, here's a theoretical question for you, Ivan, if you could have 5 real value add, smart money investors who are investing at $1.5 million valuation, and they are going to open their contact books, they're going to be kind of informal advisors sat next to you and guiding you along the right path. They're going to contribute 250K but a 1.5 million valuation. Or are you going to take what's quite rudely known as dumb cash, but basically cash without any assistance behind it, but you can get that at £2 million, that get the same cash for £2 million. Lots of founders will go, well, I'm just going to go for the highest valuation I can. Now, actually, the difference between a 1.5 and a 2 million valuation isn't huge in terms of the dilution, but the outsized benefits you could get from smart capital versus, as it's really called, dumb cash is extraordinary. I don't know if you've got a take on that.
Yeah, absolutely. On the face of it, I definitely agree. And I've got clients who took on the really smart money at a lower valuation, but that investor opened doors to clients, to more investors. A16Z in that instance was brought in by a previous investor who managed to get in very early at 500K pre-money, right? And when A16Z comes in, and that's just within 9 months, the company raised £3-4 million. So yeah, great deal for that early investor, but also great deal for the company who managed to get this contact, right? But I think there are cases where the second case do make sense when you take the money, higher valuation. Not all the companies are going down that path of VC pathway. They're going to raise 3-4 rounds, 5 rounds, hope for a unicorn exit. There are a lot of founders who are happy to build a business by raising 2-3 rounds and then aim to exit 50 mil, 60 mil. Look at Sam, you exited 30 mil. Some founders, if I were you, I would just retire, sit at the beach. But luckily, we have you in the ecosystem and still reinvesting, right? But if you ask that question to founders, would you want to exit within 5 years, 30 mil, 50 mil, and then take the cash, enjoy life with your family, I think a lot will say yes.
Yeah. And then
And
there's the risk of going on it's kind of a route, there's a choice fairly early on in a startup where, and I do need to write a ranting article on this, but, that there is a choice to be had with VC. Now, there are lots of businesses, you hear the founders go, oh, I'm going to get VC funding. And actually, they're not VC backable businesses. They're not, only 0.1% of companies or something ridiculous get VC funding. And they are very specific around the types of businesses. So lots of founders go for VC funding, even though they would never receive it. But lots of founders don't have that chat with themselves and say, do I want to grow? If I take VC funding and go that route, there is a very strong chance that, there's a 9 out of 10 chance my business is going to die. I will receive nothing out of it, or I'll get scraps after liquidation preferences.
or get
Um,
booted out as a CEO very early in the process.
yeah,
Somebody get hired in.
yeah. Or so I can do that, and it's swinging for the fences. Now, the reason why that gamble works for VCs have a portfolio of investments in their fund. They will have 20 investments. All they need is one of those to get 100 times return, and they return. They're having a very good outcome. You as a founder, you have yeah, you've got one swipe at this. You can't, maybe you can have another startup in a few years, but for most founders, you don't have a pool of investments to, it just doesn't work the same way. So
All
your
eggs in one
thought
basket.
process, all your eggs are in one basket. So for a VC, having a 1 in 20 chance of you being, they'll back you and go, we'll go for it. If I had a choice between, exiting for 50 million now or taking VC funding and having a 1 in 20 million chance of having a great exit, I wouldn't be going the VC route every day. I tell you that, unless I'd already had an exit, in which point, you kind of de-risk your position somewhat. I think that dynamic where, VCs hedge their bets by having a big portfolio and founders can't because they don't, is very different. There's also the nightmare scenario where, the FanDuel example, for example, where the founders did the usual route. They did, bootstrap for a bit, angel round. They did a VC round, and then they did a really big VC round. They took 250 million quid at a 700 million valuation. So in theory, that's great for the founders. Unfortunately, two things happened. Well, firstly, all the founders got fired, which is bad, but they did keep some shares, not that it helped. But secondly, the VCs forced the sale of the business, and they forced the sale of the business lower than the valuation that they invested at. So they sold the business for 400 million or whatever it was. And the VCs had, this goes back to your liquidation preferences earlier, the VCs had a 2 times participating liquidation preference. So
That's the worst.
all of the founders, all of the angels, and the junior VCs, guess how much they took out of that sale? You know the answer to this, Ivan.
I don't remember the detail, but
Well, not a penny. They didn't take a penny. The VCs that invested right at the
yeah.
end, they took all of their money out and they took their money again because that's what 2 times participating meant.
Yeah.
And there was not a penny for everybody else, which
Yeah.
is
Yeah.
which is just crazy. So I mean, I think there's a growing momentum around something called seed strapping, which is, bootstrap for a bit, do a couple of
Yeah.
seed funding rounds, get to profitability and grow it from there. It leaves you with a big chunk of the business and without, horrible VC type terms like liquidation preferences and things like that. Um,
Yeah.
we've got a couple of, well, we're just about to run out of time, but hopefully everybody can spare us a few minutes. There are a few questions here. The first is, we often hear investors in the US are more risk tolerant, i.e. earlier stage founders can raise more at a higher valuation without tranching. Any thoughts on this? Or is just the UK more sane? I mean, which is sane and insane? I guess depends on your perspective. But there is, you're absolutely right, anonymous attendee, that there is a big difference between funding in the UK and US. I mean, normal in the US is 4 or 5 million pre-money, raise 1 million. That's kind of what normal looks like. That's the equivalent in the UK of raising 250 at 1.5. So, there is a big difference, which is really weird because actually in the UK, investors are massively de-risked via SEI, SEIS as well. So in the US, they don't, there's QSBS, but that doesn't incentivize in the same way. So I think the market in America is fundamentally different. It is very hard for UK pre-seed, pre-revenue businesses to raise in the US. So that is a dynamic you need to consider. So usually you would use your superpower to raise under SEIS in the UK and then potentially swing to the US for your second or third funding round. I don't know, Ivan, have you got a take on that one?
Yeah, I got a. I agree with what you're saying. The UK market is just smaller. There's less money to go around. There's fewer investors. Appetite for risk tolerance is very different from US. But I think there's a lot of bashing on the UK investors,
Mm,
and not all of them are fair, right? We need to put things into context. The return that we are getting from UK angel investing is not comparable to US because it goes back to the end of the process, right? How much what's the terminal value of the UK companies compared to US? In US, you have huge silicon company, they go public market, they get
mm,
bought out by PE firm at huge multiple, all the unicorns. Whereas UK, you don't have that big multiples. So if you work backwards and say
mm,
what should be the valuation for this round, you see that there's less money, there's less lower in valuation, but that's a reflection of the terminal exit. And that itself is also a reflection of the market to the UK business. If you're a British business, you're selling to British consumers from day one only, which is
mm.
a small market. Don't forget that we take ourselves out of EU through a mechanism called Brexit, which means we lost a big market. Whereas in US, you got access to a big market from day one. I think all of that are related, and it's unfair to just bash the UK investor.
Yeah, no, I think you're absolutely right. And yeah, it's interesting you take the perspective around, the UK market is bigger both for customer base, but also for those exits. IPOs have dried up to the point of being negligible, and your only exit is an acquisition or PE or trade sale really, and that's much smaller as well. So that's really interesting. You linking that back in the VC method makes a lot of sense when you kind of talk about the UK ecosystem in that way. Judy says, "Hi Judy, she's an FC customer. Lovely to see you here. If you're not building a VC backable business, or you don't want to take that route, good on you. Should you adjust your approach to how much equity you sell to angels?" Do you want to take this one first, Ivan?
Um, I I think it depends. It's definitely going to be a very different approach. I would say if you know in advance that you only have 2 3 rounds, you take the seed strapping approach. You
Mm,
can be slightly more relaxed about who you take the money from, how much equity you give out. At the end of the process, you just got to think about what is the equity I want to still own in the business when I exit. If this business is going to go to worth 50 mil and I have 10% at the end of this journey, am I happy with just 5 mil ticket size, right? Or do I actually want to have more? So maybe 40% makes more sense. I still get 20 mil. So I think that's how you want to frame it. How much is the endpoint for you personally, right? And the benefit of this journey also in tranches is that you can make that decision later. It doesn't mean that from day one you have to select a path because maybe after 2 rounds, 3 rounds, your business has a very different dynamic. You suddenly found a way to scale this to potentially a unicorn business. So at that point, VCs, angels itself, or friends, family will not have the enough capital to support your business. So you want to go to VCs, right? So I think to answer your question, perhaps in the first 2 3 rounds, you still want to follow the well-trotted path, not dilute too much, keep to
mm,
the market averages, because you have that decision making process 2 3 rounds later. What is my business? Is it VC backable or angels?
yeah. And I think the point you made there is really important as well. There are some bit, both you and I think VC has its place in the ecosystem. I'm sure you'd agree, but it's not a panacea and it's not a one size fits all. There are certain businesses that can only ever get to the scale they could and should be via VC backing. You know, WeWork and Uber and Airbnb and all of those companies, they're never going to get anywhere near their true potential without VC backing. So I think it's understanding if your business can and you want it to become a unicorn, you're probably going to need VC support to get there, is the decision point. Lots of businesses can't even in principle, if you're, I don't know, making a special kind of footwear or whatever, you're probably not going to get to become a unicorn. So yeah, VC, you've still got that debate whether you go for it or not. Great question, Judy. Another anonymous attendee says this probably varies between startups, but typically, from your experience in this valuation bracket, 250, 1.5 million valuation, what is your typical runway time until next fundraise? That's something neither of us actually, we're remiss. We've neither touched on that today. That's another litmus test that investors will use on funding. If you're raising 250k at a 1.5 million valuation, but it's only going to last you 6 months, then investors will shy away from that probably because they'll realize that you're going to raise the money and you'll be basically starting to raise your second funding round pretty much as you start the first one. What investors want to see is you're going to raise some money, you will get your head down, developing a product, getting to the next stage, the next part of traction, whatever that means based upon your stage. If it looks like you're going to be perpetually fundraising, you're going to be distracted as a founding team through that journey. I mean, the usual, the words I hear most often are, you've got to be raising for an 18-month runway. Sometimes people want a bit longer, but there is a balance here. If your runway's, 5 years, then you're going to be raising far too much up front. Within 5 years, your valuation should have jumped multiple times, and therefore, going back to the previous slide, you want to break it into tranches. So there is a balance between, if you need to fundraise in 6 months, that's too short. If you need to fundraise in 2 years, that's probably too long. I think the sweet spot is something around 18 months. What do you think, Ivan?
I agree. 12 to 18 months, I think that's in the sweet spot. Anything less or more, you need to start questioning how much you raise or how are you spending the money, right? Because if you are raising 250k like all the other companies in the same sector, in the same path, but you only have 6 months runway, something is clearly wrong with how you're budgeting or how you spend. And one thing I always point to is the people they hire. It's quite easy to see founders paying themselves quite a lot at pre-seed stage, and they shorten the runway. And I think that's one big variable investors will look at as well.
Yeah. Yeah, lots of angels I know, they'll allow a founder to pay themselves 30,000 pre-seed, pre-revenue, maybe a little more, but anything more than that, and for a normal 250k raise with three founders, the money's going out of the door just on founder salaries. That's the dynamic. We've got a few more questions, so let's rattle through these. Thanks everybody who is holding on for these. So Peter says BBB spend government money through lots of VCs and the government rhetoric as this funding helps high risk, high reward companies. Is this true? Do VCs adjust their acceptance criteria to help these sorts of companies? So this is British business bank who throw money around from time to time into businesses. The money gets deployed via lots of groups. So there are angel groups that receive BBB match funding. There are SEI, SEIS funds that get BBB funding, and there are proper LPGP style VCs that also get this funding. I think, at the earlier stage, BBB, when they're, co-funding with any of the SEIS funds or any of the angel groups, they are at big risk. So the angels will be making use of SEIS and EIS. So that will be lower down the food chain, if you like. When they're co-investing with VCs and taking like for like investment there, that will be, the VCs aren't changing their criteria here at all. The BBB is co-investing with the VCs at the level they play. So you will never see, we've already said you've got angels, you've got angel groups, you've got SEIS funds, then you've got VCs. you will not see VCs coming down to the angel group level and investing. They won't change their criteria just because they've got BBB money, because some of their own money's going in as well. So I think that answers the question, unless, Ivan, you've got anything else to add.
No, I think you answered the question.
Perfect. Anonymous attendee says, from an investor's perspective, what are the biggest trade-offs in risk and negotiation for a price round versus an unpriced deferred instrument? Do you mind if I take this one? I've got. I could
You're
rant.
passionate in this topic.
We're out of time. Yeah, my favourite topic is ranting about ASAs. I mean, from a founder point of view, ASAs aren't great. The only, assuming you're making use of SEI, SEIS, which you would be if you're fundraising in the UK, almost certainly, the long stop date on an ASA under the SEI, under HMRC rules is 6 months. So that means you either need to, yeah, it basically, I can understand what you're hinting at here, which is my valuation is, say, 1.5 million now. In 2 years' time, it's going to be 5 million. I'm going to take on money now and convert it at the 5 million, which is all very well and good, but the ASA doesn't allow you to do that in the UK because HMRC insist on a 6-month long stop date. And what that means is, you need to close some other qualifying funding round within 6 months of the investment. And for most early stage startups, you're just not going to get enough traction to move the valuation meaningfully in that 6 months. It's different in America, when they're stacking safe notes all over the place, and you can wait for years and years and years between receiving a safe note and then converting the safe note. But just because the dynamic of the SEIS and the 6-month long stop date, it doesn't work at all in the same way. Yeah, I mean, in terms of what I think as an investor, as an ASA, I'll put a link in the chat actually whilst I hand over to Ivan here. But I absolutely hate ASAs from an investor perspective, and I don't think they solve the biggest problem for a founder perspective, which is kicking the valuation down the road. So you can probably say in the UK, why aren't you using one of the other instruments rather than ASA? The answer is they're not SEI, SEIS compatible. So if you're fundraising in the UK, your investors probably want that. You can't play any games. I don't know if you've got any other take on that.
No, I think that's the crux of the issue with ASA in the UK, because SAFE as a concept is great. I've got founders raising SAFE. They don't need to worry about the terms. Investors just write the checks, rolling round. It's quite easy to raise money, close the round as well. But when we try to fit it into the UK system, it just doesn't work. And in fact, I had managed one round where you have investors in the UK coming in under the SAFE or the ASA with 6 months long stop. Founders didn't realize and used the same document as the US version, which has 2 years long stop. We missed the deadline. We missed the 6 months. And it becomes harder to manage. We need to go back to all the investors and try to untangle it. So it doesn't have the benefits like the US SAFE does. There's, unless, of course, you're working with a family office, CVC, who doesn't really care about, SEI, SEIS.
But those more sophisticated investors won't accept an ASA. That's the crux of the problem. More sophisticated investors in the UK will insist on a price round. And I've just put a link in the chat to my rant on why I hate ASAs.
It's anyway, a good rate.
Yeah. I had a lot of coffee on that day. Thanks everybody for your patience. We'll keep working through questions. From an investor's perspective, sorry, we've done that one. Any advice on a CVC? What would investors in follow-up feel? Any risk or advantage if FTO is not impaired? Any thoughts on CVC specifically, Ivan?
If it works, it's great. I had a CVC coming into the round along with a couple of angels, and the angels love the fact that CVC is bringing tangible value to the business. But also I had another case where the CVC put in the condition that the founder can only exit through acquisition by this company in the same industry because they want to acquire the brand. Now that itself, you can frame it as, great, I've got my shareholder backing me right at the beginning and help me to shape towards the path of exit. That is until you read the small notes that ties to the limit of how much they can exit for. So that suddenly it's not great because you're painting a picture, right? Selling the dream to investors. Oh, my company can grow to XXX
Yeah.
until you read the small notes. Oh, well, sorry, your terminal value is only this, and you can only be acquired by this CVC. So not that great.
Yeah, I must admit, not many of our customers have uh, taken funding from CVC. I think, yeah, the natural inclination as an angel investor is great. There's a potential route to route to exit there, but yeah, it all depends on the detail. And all you need if the CVC owns more than 25%, they can block shareholder, they can block special resolutions, they can prevent a sale, they can prevent drag usually. So there's lots of dynamics that come into play. I don't necessarily think it's a bad thing, but I think you need to be very mindful of the dynamics of your company's very specific circumstances. And if there are, if there's somebody else that could potentially acquire you in the market, they would almost certainly be put off by the CVC being
Yeah.
present. It's kind of a one way. Taking on investment is usually a one way ticket. It's hard to buy people out, so it's hard to manage that dynamic. I would of all of the investment types we've spoken about today, I think CVC is probably the most potentially fruitful for a quick exit, but also the most challenging because of that dynamic.
Devil is in the detail.
Yeah. Um, what is your view about solopreneurs? Will you consider them if they are using fractional advisors? I think the market's really split on this. There's lots of angels who don't touch solo founders. So if you've just got one founder in your business, they sometimes won't invest. And there are a whole bunch of investors who do. So it's not a blanket, you're done for if you are a solo entrepreneur. I think my perspective is, there is something unique in startups around the founding team, i.e., they are motivated in a completely different way to anybody you hire, anybody you take on as an advisor. You know, you don't find employees often working till midnight on a bid. You don't find advisors working at the weekend. You don't find, that kind of hustle, that kind of founder mentality is pretty much solely reserved for founders. And if you've only got one founder, it's really easy for that founder to burn out because they can't do everything. Whereas the theory being, if you've got three founders, all with slightly different disciplines, so you've got the techie, you've got the salesperson, you've got the back office person. If you can bring those three disciplines, all of which have real motivation to make this a success and they're swinging for the fences, that feels very different from an angel point of view where you've got, one solo founder. They're going to bring on some employees when they close the funding and they've got fractionals around them because those people under them just aren't motivated in the same way. So your job as a founder when you're pitching your business as a solo entrepreneur is allay my fears as an investor on everything I've just said in the 5 minute rant. So yeah, it's not easy. I mean, personally, I've invested in lots of solo entrepreneurs, but lots of investors just won't go near it for those reasons. I don't know if there's a dynamic I've missed, Ivan.
I'd like to offer a different perspective because I agree with what you were saying, and I
Mm,
can see solo founders sometimes struggle emotionally, time-wise, skill set as well, limited to one aspect. There's only so much one person can do. But having a big team as well comes with its own problem. Yes, I think statistically saying that 30-40% of the start failure comes from the divorce of the founders, right? And especially if you don't put in any shares reclaim, the vesting of shares, it
mm,
becomes an issue down the path. So a team come with its issue as well if
yeah,
not planned carefully. And by the end of the day, as an investor, you're investing in the right business for the right exit. If you come across a solo entrepreneur with the likes of Sam Altman, Elon Musk, and say, I want to raise money, you're not going to force him to say, I want you to be a co-founders, would you? So
yeah. No, I think that's a good point. There's a question around. You've raised part of the funding round via ASAs halfway through actual run. You're halfway through your actual runway, i.e., money you've raised via ASAs, but not closed the round. How would that affect the remaining runway as a story to tell the investors, putting in the rest? So 200 of a 500K raise from ASAs, already spent the remaining 300k coming in at early round close, and that gives another six, seven. I think I get this one. I mean, yeah, I mean, that's the problem with taking money in advance of a funding round. You're shortening your runway because you're burning it before you close the funding round. I mean, the reality is, no matter what the optics, the reality is within 6 months of closing the price round, you'll be back fundraising. I think that is unavoidable given your situation. If you're one of the later stage investors, not the ASA holders because they're already committed their cash, so that's their problem. But if you're one of the last people to put the money into the 500k overall, you would be looking at the runway going, well, hang on, you're going to be back out, by May next year, you're going to be fundraising again, and therefore all of the things that we said earlier around the optics of that aren't great. I think the old school days of having just big price rounds where you raise 250, you wait a year, you raise another 500,000, you wait a year. I think to some extent people are more relaxed on that, where you can do agile investment or a rolling close where you keep a funding round open. That allows you to gently increase your valuation over time whilst taking money. What you don't want to do is bump into an investor at an event and then commit 50k and you go, well, wait 6 months until I close my next funding round, because that investor's going to go invest in something else. You want to strike while the iron's hot, and agile and ASA are the only way of doing that. So I don't think it's terminal, Vladimir, in your situation. I think you can explain it away, but your later stage investors are just going to have to be comfortable. You'll be raising in 6, 7 months time. That is unavoidable, I think. Anything to add, Ivan?
I think it's a framing and the planning. If it's already part of the plan that you're going to raise the amount 200k to get you to where you are, and then 300k later to do something else, and that's not a surprise to your previous shareholder and the new investor, then I don't see that as an issue, right? The runway, given how you structure the deal, agile round, has to reflect how you're going to take money in. But what I would say is this, right? If I were an investor, I look at the money you took in earlier, 200k. What I want to know is, how did you spend that money? Did you spend it to move the company along? Have you built a product, more features, spend money on acquiring customers? What have you actually done? Or have you only just managed to keep the lights open, doing what you do, and hasn't moved the company along? And then now suddenly you go to the investor and say, I want 300k. And that gives me only 6, 7 months runway. And we know that from the plan, you only start the development now, and the actual funding needs is 500k. So clearly there's a mismatch there. So I would look at how you spend money, and then look at how you want to spend the next 300k.
Yeah. Yeah, no, I think that's very solid. So that's the Q&A done. I'm not going to look at the Q&A anymore, but we have some questions in the chat. I had a quick fire on these. Angel investors from outside the UK, are there any risks, problems? Yes. So angel investors in the UK are addicted to SEI, SEIS, so that makes life easy. You offer those shares and you don't get all of the quirky VC type legal terms. If you take money from an investor in America or Europe, even if they're angels, then they will almost certainly be asking for a one times non-participating liquidation preference, which means that if the business crash, they take their money out first. I personally think that's ridiculously fair because they're not getting the loss relief attached with SEI, SEIS, but you do need to be aware of that. Quite often, foreign investors are much more used to early stage investors are much more used to kind of down round protection or anti-dilution rights, which is where, if you raise at a 5 million valuation now and you raise at 3 million, you true them up. And again, that's not SEI, SEIS compatible. So you don't see it in the UK, but you do from VCs and you do from foreign angels. So, I mean, if you possibly can, you would want money from SEI, SEIS investors because you avoid all of that lot and the legal terms. The problem is with both liquidation preference and anti-dilution rights. Once you've got them, you're never putting the genie back in the bottle. They're always getting worse from there. So as far as you possibly can, you want to defer those. I did say this was quick fire, but that was not a quick answer. Ivan, anything to add on that one?
Yeah, we've covered all the key points, but a quick diverge from that consideration that is, I think, is important, but a lot of the founders miss. If you take money from US investor, you need to make sure they are accredited investor, right? So that's a responsibility on you as well. And each state in US is different. They are governed by a different law. So that's a platform called verifyinvestor.com, which is a very cost-effective way of asking the investor to go there, verify. I think they pay just $25, $30, because otherwise you will need an actual lawyer practicing in the state of residence of that investor to write the letter to say, my investor is accredited. Yeah. And along with their investment also comes the obligation to do the filings to US equivalent of company house. So if you're only taking 50K check, 30K check from a US investor, and then suddenly, in addition to filings on UK company house, you need to file in US, that's quite a lot of work and perhaps not sensible unless you get a very smart check.
Couple of £1 million check.
Yeah.
Next question. Is there any merit in early funding going towards branding? And there is a clarification, not visual identity, more brand strategy, etc. Or if not, when does it come into play from an investor point of view? I mean, the answer is, your job as a founder is to manage the ands, not the ors. And by that, I mean, you've got to do a bit on brand, a bit on product, a bit on ICP, a bit on, employing the right people, a bit on and. Your job is not just to focus on one thing. You've got to do all of those things. Welcome to the world of being an entrepreneur and wearing every hat, but also, your business needing to do a bit of all those things. You can't have an amazing product and no brand. You can't have an amazing brand and no product and no team. You've got to kind of lift everything up at the same extent. So, don't expect to spend 100% of your money on brand or whatever, but do expect to be, no doubt you've got a pitch deck with a use of funds pie chart. Do expect to have a bit in there on brand, because I think everything's got to mature at the same pace. Otherwise bad things can happen. Ivan, any thoughts?
Yeah, that's a good answer. And the amount has to bring into perspective, right? If you raise 250K, but you spend 50K on a good design with an agency, with lots of branding strategy, lots of missing discussion, that leaves you with just 200K. Is that enough to pay for yourself, which you try to keep as minimal as possible, but also, do you have enough resources to pay for every other things that actually move the needles along? So to Sam's point, it's your responsibility and it's part of your skill set as an entrepreneur to decide how you want to allocate the resources.